It is Friday. Welcome to Risk and Rewards. I'm Lisa Abramowicz alongside John Authers. After a week in which we got a Fed decision, largely expected, 50 basis point rate hike, the largest since 2000. And then, of course, we got the jobs report that came in pretty much in line with expectations. The headline number higher than expected. Markets, absolute turmoil. What has changed, John, between, frankly, the beginning of the week and today?
I don't think, in terms of the macro environment that we know about, I don't think anything has shifted at all to change the trajectory that one would have expected. I do think you're getting to the point where markets are beginning to really confront what they have brought us to. You've seen various landmarks hit in markets, and I think that combined with the speed of the decline meant that we had, an frankly extraordinary overreaction to Jay Powell on Wednesday, and I think we can overinterpret what followed on Thursday. I think that was merely a correction of the previous day rather than anything that signals anything terrifying. But the landmarks continue to show up in both the stock market and the bond markets. Real 10-year yield is now above 0.25%. Real nominal 10-year yield is now above 3%. It keeps moving in the direction one would expect.
What do you think was the most important moment of the week? Because there was a lot of news this week. What do you think really will be the most important in shaping next week?
That's a tricky one.
If you want to think about it, I'll give you what I think it is.
I mean, in terms of thinking back home, I think the Bank of England being as quite as aggressively bearish as it was, in terms of things that actually surprised me, given that the really big set pieces, non-farm payrolls and the FOMC and the ISM data at the beginning of the week were all actually not terribly different from what a sensible person would have expected. The Bank of England sounds as though it's getting scared, which is not a good thing for a central bank to appear as though it's running scared, and that may be the biggest takeaway from the week, or the most significant development of the week.
Although, in fairness, the Bank of England is at least honest, right? I mean, Governor Bailey came out and basically said, look, we see a high likelihood of a contraction, of a decline in GDP next year in Great Britain. And we also are raising rates 25 basis points with a couple of dissenters, 3 dissenters who want to raise it 50 basis points. They are hiking rates into slowing growth. And really, to me, the reason why this is important, it's not because the UK is such a massive economy that's going to somehow overwhelm the world. Sadly, it's that is this basically the tea leaves of what's to come, not only in the ECB, but essentially down the line, even in the US, which everyone has said is completely an outlier, has completely different momentum. Is it an outlier? Is it really something that can avoid the same sort of look forward if you get the same kind of supply side shortages leading this kind of inflation?
I think there's one critical difference, which is that these days the reserve currency of the world is the dollar. If this were 100 years ago and the Bank of England were in this situation, it would be in a stronger position because the pound was still the reserve currency at that moment. The concept of exorbitant privilege, that the money flows towards the dollar at times of stress, still helps this country where we're now, the US, and it also helps reduce inflation to a certain extent. Whereas not wanting to relitigate Brexit yet again, the fact that Britain is now really removed from the anchor of Europe means that the currency is that much more open to the buffetings of world markets than it otherwise was. Other than that, everything I agree. So that there is this, in terms of why is the Bank of England being more honest, open? Why are these trends coming to a head most obviously in the UK? It's because the pound is a much less helpful currency to have than the dollar or even the euro.
And the pound is falling to the lowest going back to July, June of 2020, and it's plunging the most since the height of the pandemic. So to your point, it will just import more inflation, exactly counter to what the Bank of England wants. And yet they are hiking rates. The pound isn't responding to that. The pound is responding very much to the weakening outlook. In the US, however, I was really struck by this. Earlier today, Neil Kashkari, formerly a dove on the Federal Reserve, gave a speech in which he said that if supply shocks continue from the Ukraine war, but even more from the COVID lockdowns in China, they might have to raise rates into a highly restrictive territory. They might get away with only raising it to neutral or above if they do subside in the near term. But if they don't, they might have to respond by trying to slow demand. And to me, this is the worst case scenario. And the fact that a Fed official is coming out, especially one as dovish as Neil Kashkari has been in the past, and says, look, we don't really know. And the COVID lockdowns in China might force our hand, shows the uncertainty and the degree to which the macroeconomic backdrop is really driving a lot of action in markets in a way that the Fed can't control. And the Fed can't get ahead of, and it cannot dampen that volatility. And that, to me, is the biggest takeaway from this week, that we're going to see massive swings to tail risks that emerge because there is no Fed damper. And that alone will have a restrictive feel in markets.
That's a fascinating way to put it. Certainly, you often get overreactions on Fed Day that are subsequently corrected. I can't think of anything as extreme as Wednesday into Thursday. The last 2 hours of trading on Wednesday and the first 2 hours of trading on Thursday, I just do not recall anything like that. And that tells you something about the lack of ability. You're quite right of the lack of the ability of the Fed to set the agenda. I think with Kashkari, who apart from everything else, he was the guy who actually administered TARP back in the day. So this is about as dovish as a track record as it gets. I somehow doubt that he's being putting out a message that he's been asked to put out, although that's possible. But the symbolism of Kashkari, of all people, being that blunt does begin to get you towards the territory that the Bank of England moved into yesterday of, sorry guys, we've got to the point where we're just going to have to force a recession on ourselves. And if that's the case, which I think that's obviously been a reasonable worst case scenario for at least a year now, that this might need to happen. If that's the case, then we have further to go. Bond yields are going to have to rise further. The dollar probably strengthens further. And we then wait to see what breaks. I'd be interested. What do you think does break first, other than economic activity, other than a recession? Do you think there is some financial accident waiting to occur out there, or am I just asking the questions from the last? I'm asking the questions from the last crisis.
Honestly, it's a great question. Mohamed El-Erian was basically saying this is his biggest fear, is the market functioning risk. And he was saying this today on the Open with John Farrow, and he basically said, there are three risks right now: the rate risk, which he thinks has been pretty much priced in; the credit risk, which he thinks has not been priced in; and the risk of market functioning disappearing, and the malfunctions, the illiquidity. Also, he said that there's a liquidity issue as well. The liquidity crisis, the withdrawal of liquidity, and how that's affecting, but that really ties to market functioning. I think that it's a question of where the nodes of leverage are that have not been exposed yet, right? So as violent as things have been in stocks, there have been some buffers. And to some degree, bear with me for a second, because this is something that I've been thinking a lot about.
Yeah.
Where is the liquidity in markets? It's in treasuries right now, and it's in the mega cap stocks. You have seen such massive swings in those particular stocks. And I wonder, and in treasuries, and I wonder how much this is people using that in order to not have to sell less liquid assets, right? How much this is sell what you can, not necessarily what you want. And if things get bad enough, we really haven't seen the mass repricing in credit. Yes, it's been a huge decline, but spreads are contained. This is not a credit crisis. What could cause something more significant would have to be forced selling that we have not seen of illiquid assets. I don't know. I mean, honestly, I think that that's what people are looking for. There has been a lot of deleveraging. It doesn't look the same as in the past crisis. And frankly, in credit land, my hunch is it's going to take a while for there to be a credit crisis, right? I mean, basically, I was thinking about this today. If a tree falls in the forest, no one hears it. Did it fall or did it make a noise, right? If borrowing costs rise and no one has to borrow money, does it matter, right? If all of these companies have already borrowed all of their money and borrowing costs rise, does that tighten conditions? Does it create defaults? No, not yet. But there's a maturity peak in 2025. Are we waiting till then, right? So these are some of the things that I'm thinking about.
Okay, I do think the point on liquidity is very important. It's a point Mike Howell of Cross-Border Capital is sort of very much of a guru on measuring liquidity, makes the point that you have begun to see just the beginnings of the Fed itself removing some liquidity even before QT, and the overlap with what's happened on the stock market is startlingly close. That removing liquidity really makes an impact on the stocks. And I would also agree, yes, 10-year treasuries and FANG stocks you can always make a market in. This does look at the moment like a buyer's strike in certain cases. It doesn't look like a cascade of forced selling. Right. So perhaps I think the risk in credit is whether you can roll over your credit, because so many people have relatively short-term credit. It's whether you can roll over the credit in future rather than the rate rises at present, and that leads to the issue of whether QT really is going to have an effect. People are priced in the sort of macroeconomic impact of generally tighter conditions. They haven't yet actually felt how easy it is for them to get hold of cash once the Fed actually starts doing this. So that it's there that there's the potential for an accident. But I am conscious, like I was saying, I remember in 2008 we were manically waiting to see if a hedge fund collapsed because of LTCM 10 years before that. And one of the few dogs that didn't bark in 2008 was there was no major systemic hedge funds crash.
Except for Bear Stearns. I mean, you could have thought of some of the banks as full-on hedge funds. I mean, I'm just saying, theoretically.
Bear Stearns was a hedge fund, although but there was nothing of the scale of LTCM, which was what everybody waited for. It was a different kind of institution. I don't know whether that's going to happen this time, but that is the somebody somewhere. That's the risk that people are worried about. Is that once liquidity starts drying up in a really significant way, and America is shielded a little by the fact of the dollar, apart from anything else, but once it begins to evaporate in a serious way, then there are many more risks out there of liquidity-driven forced sales.
I would argue, I actually take what Leland Miller over at China Beige Book said, and I take it very seriously. He thinks that the COVID lockdowns in China are the biggest risk to the economy and to markets in 2022. I actually agree with him. And I think that what you're looking at right now is if they persist, it's going to cause tighter monetary conditions because they're trying to fight supply side constraints with a demand side response, which is not ideal. It's pretty much a worst case scenario for a central bank. If there is a subsiding in the COVID lockdowns and demand picks back up, what happens to gas prices? What happens to oil prices? They skyrocket. And then you have an oil shock. Either way, a fast-moving resolution one way or another could be really dramatically difficult. And I think that this is underappreciated and is creating a lot of volatility, because how do you form an outlook as a central banker with that kind of macro uncertainty?
And we've managed to get almost up to 15 minutes without mentioning the word Ukraine, I think I'm right in saying. There's
I'm laughing with pain, because it's still a horrific situation. And but it's true that that's almost not even as relevant anymore to the base case. We didn't even talk about food shortages, right?
Yes,
So it's
but
not
if
much
it,
done.
exactly with wheat in the Ukraine, there really is worrying signs of pressure on grain futures. On
Well,
oil, there are that could be the catalyst for something worse to happen if oil breaks higher again to the kind of levels it hit early in the Ukraine conflict. That's, I guess, if you wanted a surprisingly successful resolution to COVID zero in China would have a similar effect. But I think a resumed rise in oil prices would perhaps be rather dangerous at this point.
so before everybody who is listening goes and jumps off a bridge because we're so bearish, I do want to just say we are at a time. So yay for everybody else. But I will also say there are a lot of positive signs that we didn't get into. It's just that John and I are natural warriors and natural people who tend to look at these things. But, there are plenty of positive signs. Earnings are robust and the labor market seems to be very strong. So there are lots of good signs. It just feels like a tenuous moment. John, before we go, is there anything that you want to say sort of to, create some, some dampening of the doom and gloom that we put out there every day?
Some dampening of the doom and gloom. Okay, this is very dweeby, but some people have benefited during April. Worst month for 60/40 plans, both stocks and bonds since the COVID crash month of March 2020. Terrible month. US defined benefit pension plans run by companies actually moved into a surplus for the first time since 2007, according to Mercer. They now have 1% more assets than liabilities, thanks to rising bond yields helped them more than falling stocks hurt them. So we do have much less of a risk of a mainstream serious pension crisis of retirement in our future. And that's fantastic. Yay, higher bond yields.
Look at that.
How's that?
We ended so happy. That was fabulous. Thank you so much.